Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second version of When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on your show again.
Stock markets continue to take a pounding. Are investors giving up and just taking cash and running away?
I don't think people generally decide to get out that quickly. I think what we learned in 2008, 2009 was the market went down for quite a few months before people started questioning their participation. And even then, what happened was they looked at the prices, and they didn't want to sell at such a big loss, so they tended to hang on. In our experience, anyway, they tended to hang on, just ride out the pain. And the pain isn't really that great so far. I mean, there's been several months of negative returns, and clients are starting to wanting to talk about it. But if you take the whole period going back to 2009, when the market bottomed, people are still up a lot. So they haven't given back all their gains. And certainly, we haven't seen the kind of things this time like, failures of Lehman Brothers and that sort of thing to really spook people. If something like that came along, then definitely people would start questioning their participation at this point. But, and the thing that is worrying people a little bit is that really the U.S. is the only market and the only economy that seems to be doing particularly well. Canada, for example, is not doing that great, no matter what the Bank of Canada says. And even the Bank of Canada has changed their tune a little bit yesterday and today. In other countries in Europe and elsewhere are not really participating the way the U.S. investors are. So it's, but it's way too early for people to run for the exits.
So what advice are you giving your clients right now?
Well, we've been pretty cautious. Like, we've sold off most of the excess risk in the portfolios for quite a while now. So we've actually been early on this. We've been expecting something like this for quite a long time, and we're in good position for this. What it cost us, of course, was we didn't get to participate in the last year or two of the incredible U.S. market. That if you had the 5 or 6 top stocks in the U.S. the last couple of years, you made 20% a year, and we didn't get to participate in that because we were being too cautious. So now that now that the market's doing what we expected it to do, we're in good position for that. But these things, if they turn into a real bear market, which is certainly possible, we haven't had a real bear market for 10 years now. Which is unusually long, by the way. Then people will wish they'd sold for sure, and that's But then it becomes a question of too late to sell, too early to buy, and that's the point that people reach at some point.
So, is there any one area where you feel it's still safe?
Well, yes. The key thing is to avoid the overpriced markets. So, in the U.S., stocks are very expensive. If you use the Shiller PE, the stock market is still trading at 30 times, which is, the second highest ever. The only time it got higher than that was in the dot-com bubble in 1999, 2000. So if you look at that one, you say, oh, you better be careful. But if you look at some of the markets in Europe and Japan and elsewhere, which is what we've been doing, they're actually as cheap in some cases as they were in 2008, 2009 after the big correction there. So there's lots of places to look. It's just important to avoid the overpriced markets. And the reason the U.S. got so overpriced, and it isn't just the U.S. market, it's basically just a few stocks, is the way the money management business works, is people were chasing performance. The professionals have to do it to keep their jobs, and the amateurs do it because of recency bias and other human foibles. So everybody's gotten concentrated in a very small number of stocks that did very well for a long time. And so really, if you avoid that situation, the risks are not all that great. It's not terrible at all.
Are people looking forward to being able to afford the FANGs, the Apples, and so on?
Well, usually what happens is something happens like Facebook is one of the companies, and Google is one of the companies, and Apple, and in the downturn, if it lasts, say 6 months or a year, some bad news comes out. So by the time they get cheap, nobody wants to buy them. Usually what happens is your high flyers that crash, they crash hard. And then people don't really go into those ones because they're too aware of all the negatives. So what people do is they start buying things like telecommunication stocks and that. I was just looking this morning, for example, at European telecommunication stocks. They're basically trading at the same price they were in 2008, 2009. They've had no gains at all. And technology stocks in Europe, and they don't have anywhere near the technology exposure that the U.S. market has, had doubled, and now they're down to about 150% of gains, which is still much, much less than in the U.S. So those are the kind of things that people probably get more interested in buying, and they avoid the high flyers. And that probably makes sense, because often when those companies that have done really well crash, they crash pretty hard. And it turns out that some of the things they were doing to stay on top were positive in the short run, but negative in the long run.
Would stock buybacks be something then that looked great at the time, but maybe not so great in the long run?
Exactly. That's a very good example of the short run pumping the stock, if you like, at the expense of the longer run. I mean, there's going to be a whole raft of companies. One of the most amazing developments in the last 3 or 4 years was the amount of corporate debt that's been added to the companies that are traded on the stock market in Canada, the U.S., and elsewhere. It's not such a big deal in Europe and Japan. It's just sort of not in their DNA to do that sort of thing. But in the countries that do it, especially Canada and the U.S., the debt levels have gone up exponentially, and it's because they can borrow very cheaply, and then buy their own stock or pay bigger dividends or whatever combination. And often they'll do both. So the problem is when the market turns down and people start getting afraid to buy the corporate debt, then they'll wish they hadn't bought back their shares, because they were buying back their shares at expensive prices, not at cheap prices. I mean, Warren Buffett's the one that always resisted the idea of buying back your own shares, and he said he recently changed it. Under pressure, he recently changed the policy to where he would buy back his own shares, but only if they were, I forget the ratio, it's maximum 120% of book value or something like that. So just a slight premium to book value. But in most of these share buybacks in the U.S. the last few years, it's been 2 and 3 and 4, 8 times book value. So it's hard to justify those actions. The corporations should be out looking for new opportunities or finding new ways to compete with the competitors, not just buying back their own shares. Financial engineering is the term for it, and it usually only happens towards the end of bull markets.
Well, decades ago, buying back your own shares was illegal because they considered it to be stock manipulation. What changed regulators' minds about allowing it?
I think it is stock manipulation. I think they were right, but the lobbying efforts of not that long ago, we had a rule that banks weren't allowed to be in the stock market business. The banks are in the lending to corporations business, but they weren't allowed to also be in these other businesses like trading derivatives and owning stock brokerage firms and all that, called the Glass-Steagall Act, and it was repealed in 1999. The lobbying started in about 1980. And after 19 years of lobbying, they managed to get it repealed. And then 8 years later, we had Lehman Brothers failing and a financial crisis. So maybe it was right to ban companies from buying back their own shares. And certainly, it doesn't seem like it benefits really anybody other than usually just the executives of the firms that are getting a bonus for they tend to tie their bonuses to the performance of the share price. Well, the best way to make the share price perform is to buy back one of the best ways is to buy back your own shares. Because the other ways, like actually operating the company for the long term and profitably and making the right investments and all that, is much too slow for a CEO that's, I think the average lifespan of a CEO is less than 5 years. So doing the right thing, which the benefits might show up 10 years later, isn't going to help him get a bigger bonus. So they do the short-term stuff, and this is one of the biggest problems in corporate capitalism in North America is the incentives are all short-term. But all of the best kind of things to do for employees, for shareholders, for customers tend to be long-term.
Is there any way to fix that?
Yeah, I don't know. I think the bonus mentality is a big part of the problem. They're sort of talking about delaying the bonuses, so you earn your bonus, but then you don't actually get paid it until maybe 5 or 6 years go by, so that it lessens the temptation to do stuff just for the very short term. But I don't know if it's been very successful so far. I really don't know what the solution is. It's a really big problem. A lot of companies that are private that aren't trading on the public stock markets are actually doing better than the public stock market companies, for exactly this reason, that the private companies tend to take a much longer view, and they can afford to invest today, and they don't have a whole bunch of people screaming at them that the next quarterly earnings are going to be lower because they made an investment that isn't going to pay off for 10 years. So maybe that, I don't know how you get around. I think one of the things that would be great is if, I don't know how you do this, but if you got to a situation where people were shareholders for much longer terms, and most of the money in the stock market's controlled by mutual funds, pension plans, firms like that, and the people that are hired to buy the shares on those things, they have a tremendously high pressure on them to produce short-term results. And I think if you had a shareholder base that was more longer-term, maybe the mom and pop shareholders. Mom and pop shareholders generally don't sell their shares because a company misses a quarterly estimate. The whole estimate schemes is kind of a bizarre thing in the first place, because all it's really saying is the people that are estimating the earnings per share are getting it wrong. Anyway, so they did try, actually. There was a proposal to not have quarterly earnings released, and in Europe they tend to release the earnings every 6 months or even every year. They don't release them every quarter. It's more of a Wall Street thing. And I don't know. I think it's I think eventually the damages caused by this short-termism is going to be so great that people will drift away. If the executives of a company can demonstrate that they're doing better by avoiding the short term, then other companies will start copying those companies, and everybody else gradually move to a longer time horizon. And we can hope for that, because what's working right now isn't working. What's happening right now isn't working very well at all.
We'll have more with Hilliard MacBeth right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Avon Resources Limited is a gold exploration company. with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Hilliard MacBeth. Listener question, do you expect Prime Minister Trudeau will try to come up with some real estate goodies going into the next election?
Great question. I've had that question a couple of times from other people, and the big one, for instance, is there's a mortgage broker that's got an opinion piece in the Globe and Mail this morning, report on business Thursday morning, and he says that the government should. That he said a couple of times, the government should back away from the B20 guidelines. So the B20 guidelines, very briefly, is they brought in this new rule. It's the regulator that brought it in, not the government, but the regulator, I guess, is part of the government. That you have to qualify, even if you have a 20% down payment for your home, you have to qualify as if you were paying interest rates that are 2% higher than the current rate. So the current rates are between 3 and 4%. So you would have to qualify between 5 and 6%, let's say. And this has put a huge damper on the people. People were having trouble qualifying at 3%. I had talked to a mortgage broker a couple of weeks ago in Edmonton, and I noticed the rates on the wall were 3.3 up to 3.6%. And Edmonton's a relatively high income area compared to the rest of Canada. And I said, well, that's gone up from 2.75 or something. And she said, yeah. And I said, when does it start affecting people's ability to qualify? And she said, it already has. It's already, even at 3.6, 3.7, people are unable to qualify. So that would be the one goodie that the government would probably bring out. The growth in mortgage debt is, the last numbers I saw, usually during the boom, it was 5, 6, 7% year after year after year, which means the total mortgage outstanding doubles every 7, 8 years. That growth in mortgage debt is under 5%. It's headed, looks like it's headed rapidly to 0 or lower, and that'll bring house prices down very quickly, because without new mortgage credit going into the housing market, it's going to be very difficult for anybody to sell their house, and so it would be a change that the government would bring in that would allow people to qualify to buy a home, even though they don't have the income to qualify at, say, 4 to 6%. And I would be against it. I think we're better off to let the market prices come down, and then people will be able to afford homes at much cheaper levels than they've been. But who knows? I mean, the election is looming large, and I don't know. I haven't done the research, but I suspect there's never been a government reelected when housing prices are falling more than 5 or 6%. I think once they start falling 10, 20%, the first thing people do is throw the government out. But I don't think if they made a change, say for January the 1st, that it would have enough impact to affect the election, assuming the election's in March or April. I think the trend line will be in place for several months before it reverses, even if the government steps in. Short of actually going out and buying houses with government money, which I don't think anybody would recommend. I think the writing's on the wall. We're going to be they're going to be going into an election with a weak housing market, and it's going to be tough to get reelected.
Hilliard, the Montreal Real Estate Board said they've had a record amount of sales over the last 8 months or so. Not so much the same story in the rest of Canada.
Yeah, I'm really skeptical. I was in Montreal in 2015 and talked to a number of people there, and it's a different kind of market there. There's a much bigger percentage of rentals in Montreal than ownership. And I think what's happening in Montreal is there's a lot of new condo projects that they were slow to get onto the condo developers bandwagon. And it's just sort of coming now. And now this is my impression. I haven't really done the research down to the fine details, but I'd be very skeptical of predicting a trend out of what's happening in Montreal. It's just, one of the things about condo buildings, and if sales of single-family homes are really slow, and of course sales of second-hand condos are always really slow, you're really talking about just a few brand new buildings. Well, if it turns out that a few expensive condo buildings just happen to be marketed in a space of, let's say, 6 months or so, it can really skew the numbers, given that the rest of the transactions are very slow. So I'd be suspicious. I really like the single-family home, which the real estate industry is reluctant to release separately, and especially since about 2015, because that market has been very slow, and the price declines in the single-family home market are pretty widespread everywhere, even including the suburbs of Toronto. So they tend to talk about median price, average price, adjusted price. They've got a gazillion terms for these things. And the reason that single-family homes are much more important than condo prices is simply that the single-family home has a lot of land attached to it, and it's the land price that actually drives the market. The component, there's the building materials, there's the labor that goes into constructing the house, and then there's the land. And the building materials are going up a little bit now because of problems with free trade and tariffs and all that. Labor doesn't change much at all over the years, other than in the 70s. There's been very little change in the cost of labor. So the big fluctuation is in the land. And individual condominium units, or strata units, have very, very small amount of land, maybe 10 to 15% of the total price is land, and the rest is the building. So you have to look at, in my opinion, the single-family home trend, and the single-family homes peaked in Vancouver in about 2016. They peaked in Toronto in about 2017, and they peaked in Edmonton and Calgary. In Edmonton they peaked in 2007, and in Calgary, arguably, I guess they peaked in about 2014 before the big OPEC crisis that hit in December of 2014. So in 4 big markets in the country, single-family homes have already been in decline for several years now. So when you see the average prices, just remember that it could be skewed by luxury condominiums, which are not, in my opinion, representative of the market.
Was it a mistake by developers to just build luxury condominiums?
Well, the neat thing for them is once they get that 70-80% sold hurdle accomplished in the condos, they're out and they don't care anymore. Their responsibility is ended. They spend a bunch of money on advertising. They spend a bunch of money on features like a room for parties, or I saw one which was a photo booth room, and it's like all this stuff. And then they lure the people in, they have sort of fancy appliances, and then they charge them $600,000-$700,000 for the condo unit, box in the sky, really. And what they've really done is they've taken a chunk of land which they vended into the project, probably at triple or quadruple or quintuple what they paid for it. And then they hire some contractors, some general contractors, some designers, some architects and all that, sell the buildings off, collect a small profit per unit, or maybe a big profit if they're lucky, but it doesn't really matter. The main thing is once the building is substantially completed and the financing is the construction financing has been repaid by the sale of the units to the individual owners, and the condo board takes over, the developer doesn't care anymore. And I talked to some lawyers in Toronto a couple of years ago, and they said almost every condo building in Toronto has a lawsuit or several lawsuits. They said every building could have a lawsuit, but some of the owners just turned over the condo board and they find out the situation. They're reluctant to sue the developer because it taints the building. They might prefer just to try and sell their units to somebody else and to get out of the bad situation rather than taint it with a lawsuit, because nobody's going to want to buy a second-hand condo in a building that has a lawsuit. So the developer's gone, and I said, well, what happens in the lawsuits when you sue the developer, and he said, well, the developer doesn't have any money in the corporation that was created to do the condo development. So basically, we do sue the developer, but essentially it's insurance. The insurance ends up paying. So all the people that buy condos are paying for the insurance premiums so that the insurance companies can make these settlements on all these lawsuits. And it's a terrible model, really. I don't like it at all. And unfortunately, the single family homes eventually will come back. I would argue that it's going to be a long time because this is a big bubble, and now that it's bursting, it's going to take a long time for it to come back. Small condo projects could be all right, but the high-rise condos, it'll be forever because people are paying too much for them, and some of them were poorly built, and then they'll be 10, 15, 20 years old, and nobody wants a condo. The maintenance cost on a condo that's 15, 20 years old increase dramatically. So now all you've got is a responsibility to maintain a building that's wearing out rather than an investment. It's not an investment at all. Whereas a single family home, eventually the structure that's sitting on top of that piece of land goes to zero value, obviously, after 20, 30, 40 years. But the land itself can still appreciate in value enough to make up for the need to replace the building.
We'll have more with Hilliard MacBeth right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, the chief financial officer of Huawei Phones, was arrested in Vancouver and being held for extradition into the U.S., where they're accused of avoiding U.S. sanctions on Iran. And of course, they deny any wrongdoing. Is this a case of the U.S. State Department wanting to get their hands on somebody from Huawei because Huawei's accused of spying on behalf of Beijing?
It's really interesting. I did some reading on it this morning. I'm fascinated by this story. It's obviously the stock market, as we speak here on Thursday, is down 2.5% right now, and it had been down quite a few days in the last 2 weeks. And it seems to be affecting the stock market. So what's happening is there's a new, remember we had 2G, and then we had 3G, and then we had 4G, and then we got LTE, and well, the new thing is called 5G. And apparently the 5G is a huge, huge leap forward for the internet and for mobile networks. So it turns out that Huawei is one of the leading companies in 5G, and it was in 4G and possibly in 3G as well. And there's 5 countries in the world, according to my research this morning: the UK, Canada, the US, Australia, and New Zealand, and they have a nickname called the Five Eyes Intelligence, and they have become concerned about China using Huawei to spy on them. And of course, the problem is when 5G, and it looks like there's no question 5G is going to get rolled out quickly. When it gets rolled out, then that would give whoever installed the equipment the potential to spy or even to disrupt internet network. And we've become so dependent on our internet network that the world would shut down if the Chinese controlled our network and decided to shut it down. Now, Huawei claims they're a private company, and they're not a arm of the government, but a lot of people are skeptical about that. If you read about China, you find out that the government is involved, especially under the new leader, the Communist Party, and the government has gotten more involved in some of these companies that are the key companies. So U.S., Australia, and New Zealand have actively banned Huawei's equipment and don't allow them to be used in the internet network, the backbone of the internet. British Telecom, BT it's called now, has just decided to remove Huawei's equipment from their 4G network. So this is not even 5G, and so it's obviously there's obviously a lot to this story. And now the CFO happens to be the daughter of the company's founder, and the father was a key leader in military in China, apparently. So there's always been a suspicion that the Chinese army has been one of the internet operators that's been behind some of the disruption that allegedly China has done into U.S. and other countries. So you can see how people are putting it together. Now, apparently their crime was, according to the U.S., was that they tried to sell or they installed internet backbone infrastructure equipment in Iran to extend the internet to the rural parts of Iran. And that sounds pretty innocuous. Obviously every country wants the rural parts of their country to have internet access. It's certainly a big issue in Canada as well. And but the U.S. has taken exception. So, but what occurred to me when I heard this news about 24 hours ago was that the U.S. would have to show the Canadian police some pretty strong evidence to convince them to take the actions of actually arresting an individual and detaining them in a jail cell. So,
I believe here in BC, TELUS is using Huawei to put in the micro cell towers needed for 5G. And they say they're not concerned about any connection to the Chinese government. Who's making that decision at TELUS?
Yeah, it's interesting. I mean, one of the disadvantages we have in the U.S. and Canada compared to countries like China and Japan and in the past and others is that we tend to let people do their own thing rather than have the government, heavy-handed government, stepping in and directing things. So, one company, TELUS, is allowing Huawei in, and maybe Bell Canada and Eastern Canada is not allowing them. The internet's always been one of those things where it actually would make more sense probably to have a universal standard and have a government, worldwide government dictating what the new standard is going to be and regulating it. But at the end of the 70s and the early 80s, we went to the system where people believed in deregulation. We already talked a minute ago about what happened with the banks when they and the investment firms when they deregulated those ones. It was a pretty big disaster in 2009. But everybody's gone for this deregulation. So the opportunity, the possibility of re-regulation is even more controversial when it comes to the internet, because people would perhaps rightly say, well, we don't want the government watching our every move through the internet. But the question is, which government is it going to be? Do we believe so much in deregulation and free markets in Canada that we don't allow our Canadian government to watch it, but then we turn it over to the Chinese government to watch for us, and that seems like a really odd thing to do. So the situation with Huawei is that they are a huge provider of the only one that's bigger in the world is Nokia, the Finnish company, and everybody remembers Nokia phones. At one time, we owned the shares of Nokia, where there was 400 billion phones a year being sold or something like that. Then they didn't make the transition to the smartphone, so Apple and all these other companies took over the handset business. But apparently Nokia kept making the internet equipment and the cell phone equipment. So number one in the world is Nokia with 32%. Number two is Huawei with 26%. But the internet has become so important to everybody that I think that it's inevitable that the government at some point will have to start directing traffic at least a little bit. And I don't know if the U.S. is foolish to think that the Chinese are going to back down because they arrested the daughter of one of the founders of one of their most important companies. But the chances of that happening are pretty close to zero, in my opinion. The Chinese are not going to be humiliated by the U.S. Their history is they feel like they were humiliated for 100 years up until Mao came along, and now they're determined to become a world power in their own right, and they're not going to be pushed around by the U.S. or Canada or Australia or New Zealand or anybody like that. So if this is I don't know what this is, but if this is just a negotiating tactic, for example, to try and soften China up, it's not going to work, in my opinion. I think the chances are that the Chinese will push back even harder. And of course, it's partly about China's alleged tendency to steal technology from the rest of the world, and that, according to political analysts that I've talked to, whenever the U.S. President Trump beats up on China over trade and technology transfer and technology theft and that sort of thing, he gains popularity. So there's absolutely no incentive for him to back down. So maybe this is why the stock market's down as we speak here, close to 3%, because people have figured out that this is the kind of fight that could get really ugly.
Alberta cutting oil production to help boost Western Canadian Select prices. Is that a good strategy, and will it work? So this is really interesting because it kind of ties in with what we're talking about with the government involvement. So this has happened before in Alberta. The basic announcement was that some of the producers in Alberta want the government to step in and cut back. It's like when I researched the book on the real estate crash. One of the obvious things that came out was the lenders were lending too much money to too many people to buy houses they couldn't afford. And one of the CEOs, Ed Clark, said, well, he agreed with that view, but he said if we cut back on the amount of mortgage money we put out, somebody else, one of our competitors, will just step in and do it anyway. So the government has to control us. In other words, we can't control ourselves. We have to be controlled by the government. So here we have in Alberta all of the vendors trying to sell their Western Canada Select at a ridiculously low price of under $20 a barrel. And some of the producers are going to keep doing it because it actually benefits them. And but a bunch of them that were just purely oil sands play people are getting killed at this price. So they lobbied the Alberta government to force all of the companies to cut back on their production of that particular item. And the prices, the day after they announced it, the price jumped from under $20 to over $30 for Western Canada Select. Now, people might not be aware that Western Canada Select is not just bitumen. It includes what's called a diluent, which is a liquid, which is actually very expensive. It's over $50 a barrel. So they're mixing the bitumen, which doesn't flow in the pipeline at all, or barely flows, with this diluent, which makes a blend, which then will flow in the pipeline. And so, of course, they got to buy the $50 or $60 diluent. It's about 20 to 30% of the volume, and then they put it in the pipeline. It still moves very slowly through the pipeline, and takes up a lot of pipeline capacity. And the argument the government's making is it's crazy for us to be selling it at under $20. It basically means that we're getting almost nothing for the bitumen after you factor in the $50 you're spending on the diluent. So, but the only way they can stop themselves is if the government steps in and says, don't do it. So the companies that are against this move by the government are the companies that own refineries in Canada. So they take the bitumen, they don't send it down the pipe with diluent, they actually upgrade it. There's several stages of upgrading, which is too technical to get into, but essentially there's refineries near Edmonton, there's a refinery in Lloydminster that Husky owns, and so Husky, Imperial Oil, and Suncor, all of the people that have a significant business with upgrading the bitumen to something that's similar to regular product, and sells for a really good price,
they're against the move. Whereas the companies like Canadian Natural Resources and Meg Energy and a couple others, Cenovus is the big one, they were all very vocal about asking the government to force people to cut back. And it's quite fascinating to listen to CEOs that are rah, free enterprise, get the government out of the business of being in business, and then watch them lobbying the government to step in with a very heavy hand. I mean, there's no doubt this is one of the heaviest interventions ever in the history. So I mentioned a minute ago that this has happened before. So I researched, and when it happened was in 1981, and it was over the National Energy Program, and Peter Lougheed, the Premier of Alberta at the time, started to cut back the production of oil. At that time, it was light oil. It was conventional oil. It wasn't oil sands. And most of the oil was going to the east, to Sarnia, the refineries in Sarnia and other places in Canada. And Ontario was dependent on Alberta oil at that time. And so they started to cut back. They started in March. They did another cutback in June. And they announced a further cutback in September of 1981. And the federal government, led by Pierre Trudeau, Prime Minister Trudeau, and Marc Lalonde, the energy minister, or maybe he was the finance minister, came to an agreement right at the last minute of September before the third round of cutbacks kicked in, and they agreed to keep the oil flowing to Ontario. And that was when people in I don't know how many people remember the famous bumper sticker, "Let the Eastern bastards freeze in the dark," but that was the time. So what happened after that? For several years, the oil industry got deregulated, and it was finally deregulated entirely by about 1987. So for the 6 years after that happened, the government stepped back from the oil business pretty much, and by 1987 it was fully deregulated. Except for a few environmental restrictions and stuff. And then they started selling more oil to the U.S. and less to Ontario and BC. So this has happened before, but the time before it was an internal dispute with the rest of Canada. This time, it's most of our oil goes to the U.S. and that's where the danger lies, because we could get into a fight with the U.S. and we are by far the biggest exporter. Canada, mostly Alberta, exports 3.5 to 4 million barrels a day of product, and the U.S. only imports about 7 million. So we are more than 50% of the market. And nobody else has even 1 million barrels. Not even Saudi Arabia has 1 million barrels. So if we get into a fight with the U.S. over the exports into the U.S. Because we did this cutback, then we're gonna feel like maybe it wasn't such a good idea. So I don't know what's going to happen. It's a pretty drastic move.
The BC government has decided it wants to go totally green when it comes to cars on the road. So they have a plan to turn BC totally electric within a few decades. What's that going to do to the oil business, and what does that do to the car business? Because you have a Tesla. How often do you have to take it in for servicing?
Well, so I've got a different view on this because I've had a Tesla for coming up to 3 years now, so I'm one of the early adopters. And then our family just got a second Tesla, the new Model 3, which is the allegedly cheaper model, although in Canada it's not really that cheap. But so now we no longer have to go to gas stations, and we do have to go to charging stations, or we have to charge at home. And but that turns out to be pretty simple. It's not as big a deal as people. And the two cars have a range of between 500 and 600 kilometers of distance travel, so that's not a problem in normal driving. It's only becomes important when you want to go from Edmonton to Vancouver or something. And then they have Superchargers lined up. So I looked up, before we got the Model 3, I looked up the maintenance requirements for the Model 3, and other than topping up the windshield washer fluid and rotating the tires, which in Edmonton, of course, you do twice a year anyway because you switch from winter to summer tires, at least we do. The only maintenance items are every 2 years they recommend that you flush the brake fluid, but I don't think that's actually necessary because you almost never use the brakes on an electric car. And every 4 years, you are supposed to check the cooling fluid that circulates in the battery pack. Well, that would definitely be something you'd want to do because it's really important that the battery pack does not overheat it's usually the dangers during charging. So that fluid is very important. But it's a sealed unit, so only Tesla can check it, and it's every 4 years. So the maintenance costs should be very low. The electricity costs are much lower than gasoline costs. It's saving between $1,000 and $2,000 a year in petroleum purchases, and saving between $1,000 and $2,000 a year in maintenance costs as well. So depending how much you drive, so $2,000 to $4,000 a year in savings. In 20 years, you could make up the cost of the car, the differential in the cost of the car. But I think we just had this Tesla 3 a couple of days now. So driving around, it's such an amazing experience that it won't matter if governments ban or say that cars have to be electric. I know Norway said that all cars have to be electric within maybe 5 or 6 years. It probably won't make any difference because people, once they experience the electric situation, they'll probably want to switch anyway, even if the government doesn't order it. It's a whole lot more fun to drive an electric car than it is to drive a gasoline car. So.
What about performance in cold weather? People are worried about that. Obviously, Edmonton is a little colder than Vancouver.
Yeah, it definitely is a factor. So I mentioned the 500 to 600 range. So the Model S, my car's got a 500K range. The Model 3, which is a lighter car, smaller car, has got a 600K range. And in the very cold weather, like we have right now in Edmonton, it's minus 16 out. The range of the 500K car probably drops. They say in the book by 25%. My experience is it drops more than that. It drops more like 35%. And that's partly because you run the heater in the car, which takes a lot of energy. The heated seats, I don't use the heated steering wheel very often, but it's available. But the other reason that you use a lot more energy in the winter is the battery doesn't operate as well in the cold weather. People know I've been riding up a ski lift in Whistler, and when it's cold, and people are trying to warm up their iPhones because the battery, when the battery gets too cold, it doesn't work. So you have to preheat the battery in the car, which you can do from the app on your phone, to get the performance when you actually. It's kind of nice actually. You turn it on 3 or 4 minutes before you get to the car, and by the time you get to the car, it's nice and warm. And the battery is been heated up. But that takes energy. So I'm thinking that people should expect that it's probably more like 35 to 40% in the city and maybe 25 to 30% on the highway of loss. So what that means is it's still very manageable. In the city, you don't really notice it because for me, 500K lasts me several days. And pretty much all of my charging is done in my garage at a level 2 charger connection that we've put in, which is 240 volts and 40 amps. And the car has the ability to go up to 80 amps, but the regulations, I think, don't allow you to have a circuit in your home higher than 40 amps. So that's not a problem. I just maybe have to do it every second night instead of every third night, if you like. And on the highway, one would have to stop at a supercharger more often. So the 500K range car can reach Calgary in normal weather without any problem, without stopping. But in the winter, you might have to stop. There's 2 supercharging stations between Edmonton and Calgary, and it'll be like a 20-minute, 30-minute stop. I'd have to stop once. So that's the main impact would be if I'm going to Calgary, I'd have to stop for 20, 30 minutes to be sure that I'd have lots of juice extra at the end. I'm pretty sure I could make it to Calgary, but the margin for error would be kind of tight. So And Vancouver, I've been to Vancouver. There's charging stations all the way along. And of course, if you go into the U.S., which I haven't done much of that, the charging stations are even more frequent. The bigger problem, I think, is going to be if there get to be too many Model 3s out there. You might have a lineup at the charging station. I did see on the internet in California, there was a 20-car lineup at the charging stations to charge the cars. So, and the other problem that I've heard about is if you don't have a single-family home like we have, if you live in a condo building or an apartment building, you might not be able to get that 240-volt, 40-amp installation put in. So what Tesla's done with that is they've installed superchargers in the cities. Originally, they didn't have service chargers in the cities. They just had them on the highways. But now they're installing a couple of superchargers in the city for people that just aren't able to charge at home for whatever reason.
How long does it take to charge up?
So on the level 2 charger, the 40-amp, 240 volts, it's the same circuit, by the way, as you have for your clothes dryer or your stove in your house. And you can actually plug into that thing, but most people get a separate circuit put in their garage. It takes about 5 hours, so you get about 100K an hour at home. And in the supercharger on the highway, if you were totally empty and you wanted a totally full charge, it would take 1 hour. So it's basically 5 times faster at the supercharger. The supercharger works differently. It's a much higher voltage, and it uses direct current. There's probably too much information for people, but the charger is actually it doesn't use the charger in your car, which is what happens when I charge at home. There's a charger installed in the parking lot where the supercharger is, and it goes directly into your battery. So it's a much more powerful charger, and they're talking about even faster chargers. BMW, this gets quite interesting. BMW, Mercedes, Volkswagen, they're all working on this. I noticed lately, now I might have imagined this, but I've noticed that they've stopped bad-mouthing Tesla. So I think that they were trying to delay people buying Teslas until they had an equivalent offering. And BMW is quite advanced. Volkswagen, I'm sure, will catch up fairly quickly. And what they're talking about is taking a slightly different route from what Tesla did, making the car a higher voltage, and basically 800 volts of a circuit in the car of 800 volts, which would allow charging in 10 or 15 minutes rather than an hour that Tesla takes. So there are some problems with having that high voltage in a car. For one thing, it's very risky. If you touch the wrong part of the car, it isn't just like you might be electrocuted. You will be electrocuted. There's nobody ever survives an 800 volt. I talked to a car mechanic, and he was quite excited about this, but he said the training is very extensive because they don't allow any mechanics that don't take the training to work on these cars, because it's basically an execution if you happen to do it wrong.
Hilliard, thanks for being on the show.
Nice to be on your show again.
My guest has been Hilliard MacBeth, author of the new version of When the Bubble Burst, Surviving the Canadian Real Estate Crash. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet, our YouTube channel, Talk Digital Network. Questions for the show or our guests can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.